The markets are closing out the week on a high note as Meta is absolutely ripping and it is pulling everything up with it. We'll be discussing that and much more today on Money Never Sleeps. Welcome back, everybody. As we get going, do us a favor, hit that like button, subscribe to our channel. Nothing that Kevin or I say is financial advice, so please do your own research for making any buys or sells. Kevin, it is a hell of a day in tech. Meta had blowout earnings. They're going to be dropping a dividend, all sorts of crazy stuff. And we are seeing a huge rally as a result of it. The NASDAQ up almost 2%. Amazon having a solid day. Meta's up almost 21%, almost $82 a share. Absolutely insane what it is doing there. What are your thoughts on the market as we speak? We'll get into the jobs report as well, some of the numbers there, what we can believe, what we can't believe, and then we'll get into earnings after that.
Yeah, I guess my thoughts, and I'll just get into Meta real quick. Yes, they beat earnings expectations, but they beat expectations, and there's still some big caveats you have to have when you look at some of these stocks. And the other thing, we talked about it very briefly, maybe 3 episodes ago. We talked about the stock buyback window for corporate shares to be bought back by these corporations. They kind of announced that they were doing that. So that's also helping out there. But more than anything, I'm going to bring this back to CZ. Seems like the Mag 7 is now the final 4, right? Seems like the ones that were at the top are starting to bleed a little bit. And it's not huge, it's not super bad. But if you look at the indexes and how much it's up, and we see the top 4 stocks and out of those Mag 7 that are doing well, it ain't Tesla, it ain't Apple, and it ain't Google for necessarily, right? So it's really interesting to see how the window is kind of shrinking on some of those. It's going to be interesting to see if they continue to offer value. But, that's just my thoughts initially from seeing those earnings and kind of where the market is today, being up so much for 4 stocks that are pretty much Atlas holding that globe up for just a little bit longer.
All right. Man, this feels like peak euphoria. And I just to be transparent, I'm taking some off the table here. Like I did. That's my game plan is kind of de-risking a bit, taking some gains and just kind of waiting it out. Cause it just seems like Cramer, when Jim Cramer is taking victory laps the way that he is right now, it is a really good indication in my mind that we might be near the local top of something. So I think this is a great time. Just, once again, do what's best for you, but it's never a bad time to take some profit. And if you're heavy in tech at this point, maybe I'm wrong, maybe I'm not, but it's a weird time. And these numbers just keep it's crazy. It's really crazy to look at this chart of Meta right now and look at the monthly and where it was in November of 2022 and back, in October of that year when Jim Cramer was crying about it on CNBC, and to just see the insane turnaround it has made from when it hit that local bottom, a 410% increase just about. That's nuts. And I feel like at some point expecting it to keep going up is just peak stupidity.
I think we're past peak stupidity at this point. And again, it's really interesting right now when, I was looking for the tweet exactly, but it was something about Meta's, pretty much the metaverse once again for Q4. It's still bled out 4-point-something billion dollars. That's a pretty big loss still, regardless, right? So I don't necessarily understand what Meta is doing, how much they're making. We can take from the numbers, obviously, sure, but I think a huge part of that obviously is people still betting on AI, which is unfortunate because it's not necessarily a product that currently exists, right? They're just talking about it. And the other thing is also the fact that they had so much cash that they could just shoot 50 billion into a stock buyback. The other thing too is the dividend. People got excited about that, but you don't get I don't know, man. It seems too good to be true. You don't get dividend news when the stock is at the bottom, right? You're not going to hear that they're going to offer a dividend for, when Meta's down here at $100 or so. Up here at 476. I don't know. Is this any different than the Bitcoin ETF at this point? I don't know. Just kind of narrative things, but this gap is just absolutely massive. I don't believe it. I mean, I do believe it. I see it right in front of my face, but I don't buy the fact that this gap isn't going to be is going to stay like that forever, right? I mean, look at this. This is up 20% right now. It shot up $82. Is up in post market, and it was up this morning pre market. But that's a whole lot of liquidity that's just missing there. There is no support whatsoever, and you're at all time highs. You have to find that support. And I'm sorry, that support right now isn't up here. It's not here. It's not even here. It's actually down here around 383, which is not too far from where we were. So we never came back and we never retested 383 when we were on the way up. That's a very dangerous thing. And again, the volumes have been extremely low for Meta as well too. If I zoom in here, we just had a really big spike yesterday. So one of these days, you're getting all this bullish news for the time being. Wait till it doesn't. It's not bullish news, right? That's kind of the dangerous part here when you look at some of these tech stocks. But for what it is, if you had Meta, good for you. I'm not upset. Again, this is like Nvidia at this point. It's like is what it is. There's nothing you can do about it. But there's a lot more going into this that's going to impact this price, and we can talk about it in a little bit. But I don't buy this one bit for being a new bull market and starting up for Meta going to 900 or 1,000 or whatever Kathy Wood, Jim Cramer want to say it's going to go to.
Yeah, nice little double from here. That would be something. Let's talk about jobs for a second before we get into earnings. We had the the January jobs report come out today. 353,000 jobs added versus 185K expected. 3.7% unemployment versus 3.8 expected. Hourly wages up 0.6% month over month versus an expectation of 0.3, and that comes out to 4.5% increase year over year. So now hourly wages are outpacing inflation based on the numbers that we've been seeing lately. So that is a positive for the consumer, for the health of workers out there. That's a good thing. What does the Fed make of these numbers is the question I have. Like, we've gone back and forth on this show about whether or not at this point the Fed even cares about employment when it comes to cutting or raising rates. Like, because if they still cared about it, this would be pricing in a rate increase. Now, we have seen big movement in the futures. As we stand right now, it's about 80% chance that the Fed skips a rate cut in March. That's up from a 62% chance just yesterday. So clearly the market is pricing in that the Fed is not going to cut rates as a result of this jobs report from this morning. So it is good one there, Chris. It is an interesting time and a tough decision for the Fed. They're going to have another month's worth of data before the March meeting. So they got plenty of time here, but that's really a shocking number in what was supposed to be allegedly a cooling jobs market.
Absolutely. What was the expected? Like 153,000, 185, 100,000, whatever it is.
Almost doubled.
Yeah.
So it was almost doubled. Like that's nuts. That's what we were seeing a couple of years ago. Like that's still crazy.
I do want to show this though. This is from Zero Hedge. Obviously, some people like Zero Hedge, some people don't. I respect it because it seems like you're not going to get any news from the headlines. So you kind of have to look in the data, and these guys did a pretty good job at going into it. So the interesting thing here that I saw out of all of this was the hours worked, and it says that BLS decided to sharply slash number of estimated hours worked from 34.3 to 34.1. Now, is that crazy? No, not necessarily, they're saying, but the fact that we haven't seen those levels since 2020, and this is around the same time the shutdown of COVID. So this is where we currently are, and this is where COVID was down here. So maybe there are more jobs, but everyone's working less hours. And if that's the way that we're skewing the data, then that's not necessarily bullish, is it? Right. And it's wild when you see the divergence between ADP and then the BLS. That's a big difference. Now, the interesting thing here is what does the Fed do, like you said? Well, what happens if they're operating on this data that isn't necessarily honest? Maybe it's very skewed, right? Well, then that just makes the problem even worse. We do know we're in an election year. I'll have the balls to say this 100%. So data is going to have to look great. right? No incumbent wants to be going into an election with bad data. So a strong labor market, this narrative makes sense. Maybe that's why they're changing some of the way that they calculate some of the data. Is what it is, but jobs are definitely going down in terms of hours worked, right? The amount of hours that people are working is definitely going down. It's a sign of some contraction. Job numbers still going up, whatever. But the interesting thing here is if the Fed is operating off this data and it's not nearly as strong as people are, expecting it to be based off the headline, well, are rates staying higher for longer for no reason? That's the scary thing too, because we know that the longer rates stay this way, guess what happens? The faster that the money supply is shrinks and debt is not created, it is destroyed. And we're a debt-based economy, right? Prior to contrary belief, you know, America doesn't run on Duncan, runs on debt. And it's just the truth, right? I mean, everyone thinks that they understand the monetary system, but if you don't have debt being created, the economy's going to slow to a halt. It's a fucking terrible situation. But if they have the rates still high and the economy is shrinking, people are working less. Working less doesn't mean more money. That just means that wages are staying the same and you're just getting a few hours less per week. It's a very dangerous situation. I don't think that that's bullish one bit. I think that's something that's the market kind of isn't pricing in right now or expecting, and the headlines are just not 100% truthful. I'm sorry. I call bullshit. Let's put it that way.
It's a dangerous game, friendo. All right, we had those Meta earnings, which we mentioned at the top. For those who didn't see them already, Q4 revenue increased 25% year over year to 40.1 billion. That is a big increase. They're now forecasting Q1 sales this year of 34.5 to 37 billion. Net income tripled from
Good fucking luck,
4.5
suck.
to 14 billion. And they will be beginning in March, I believe March 26th, paying a dividend for the first time. It's going to be 50 cents per share. They're also buying back $50 billion worth of their own stock. So Meta has just an ungodly amount of cash sitting around. So they're like, yeah, we'll give some of that back to shareholders and we'll go ahead and buy a bunch of our own shares. Absolutely insane. I mean, I don't know. I don't know what to say. Like, it's a huge hit on the bottom line. Like, everyone's praising Zuckerberg right now that he's maturing, that they've gotten through the toughest part of their business, that him paying a dividend shows that, this company has really made it. Man, it's crazy to me. And maybe we got to look like closer, but got to go below the hood and take a look at everything. But it's wild that they had this kind of an insane earnings and so much hype around AI, around Llama, their large language model. Is that really going to be the savior? Or, I part of why I sold a bunch of my NVIDIA today is I do believe that we are approaching an AI bubble, and that bubble could burst any day. Maybe not, maybe not today, maybe not tomorrow, but in the not too distant future, everything is just like, this is the bubble gum that is holding the wall up. You ever see Vegas Vacation?
Yeah.
You know the part in Vegas Vacation when Clark's in Hoover Dam and the water's coming out of the wall and he starts sticking bubble gum on it and then water shoots out a different spot? Well, at some part, Clark ran out of fucking water or ran out of gum.
Bubble gum.
At some point, the bubble gum on this AI bubble is going to burst.
Yeah, I mean, I don't necessarily buy this shit one bit. And again, I always go back to the banks because that's honestly where all the money is coming from. Liquidity and collateral are more important than technicals and expectations at this point. The market just doesn't realize that yet, right? We'll talk about that when we talk about what the Fed is going to get wrong in 2024 as opposed to 2008. But yeah, it's 100% a bubble when you see four stocks holding up the entire market. And I say four because I do believe we're in the final four now. I want to pull up the hold on one second. Let me just pull this up. I want to pull up the major indexes today because we know that they're heavily weighted. I think 30% or so have exposure to the top seven, but I want to see something here. So this has pretty much been the chart for the S&P for since October, just nonstop up, right? I mean, this is literally like fucking Spider-Man climbing a building, just straight up and down. But if we look at this here, everyone's extremely bullish on AI and everything. So obviously this is going up. Why is the Russell down today? Right? I mean, and it was down more earlier. The Russell's not doing the same thing that the tech stocks are doing. And if anything, to me, this looks like it's ready to put in a corrective move to the downside. And again, where is the Russell by comparison? Well, if we had so many jobs, then why isn't the Russell also doing extremely well? Why is that? 350,000 jobs or something like that. And here we are just kind of trading sideways once again on the Russell. It's because the larger economy isn't doing great. It's slowing down faster than people anticipate. It's going to slow down even harder after March, but this is not bullish one bit. And I saw Zero Hedge also put out a tweet really great that was talking about how people are really excited about how the jobs numbers are coming out and they're betting on AI, but AI is also, those companies are betting on the fact that people won't have jobs. So it's just hilarious that people are pretty much like betting on their own future. AI is gonna, do so much. It's like, yeah, you guys probably won't have a job at that point too because it'll take over. But it's really funny to see that. Outside of that, I think we should go into Asia because some stuff did happen in Asia again last
Let's
night.
do it. Go for
Pretty
it.
big, pretty big stuff. So one of the top banks in China, not PBOC, but ICBC, the chairman resigned as Chinese banking industry undergoes leadership reshuffle. Not necessarily a great sign you want to see, right? They claim that it's because of old age. The guy's 63 years old. I don't necessarily believe that's the reason why. I think there's some bigger problems within the banking industry in China. And a lot of people don't know this too, but a lot of these smaller banks throughout all of mainland China are being consolidated into parts of bigger ones. So they're pretty much eating up a lot of these smaller banks. That's not a good sign either. That's very, reminiscent of what we saw back in 2008, 2009. A lot of the big banks started eating up a lot of the smaller ones. And again, does that, pose risk to a lot of these bigger banks? Yes, it does, 100%, because now you're just eating up bad debt. We talked about that yesterday too. So there's a lot of stuff that's going on in China that's quiet. China's been selling off too. A lot of people have been saying that liquidity is going to help out. I have not yet seen it help out. We had a good move up roughly to 16K in the Hang Seng, but as of last night, we're at 15.5, right? And let me just pull this up on the daily. This is where liquidity was injected. We moved from 1504 to 16,260. And then where we closed this week was right here at 1553. So this is not, 15,530. That's where we closed. Sorry, too many numbers for me. But yeah, I mean, we got that little news that bounced up. Now we're coming back down. I mean, the saying, what was it? The Shanghai composite, even worse, right? It's dropping down even lower. I mean, it's lower than where we were back in. Well, it's approaching 2020 levels, so that's really interesting to see there. But if you lose that 26.49 right there, which is only about 70 or so points, 80 points away, I mean, there's a good chance I mean, even if we look at this on the grand scheme of things, we already lost this massive trend line that we've been in since. I mean, that's December 2013, 2008 back here. Actually 2005. So since 2005, this trend line is held as support. It didn't hold as support this time, and that's kind of a scary thing to see. So a lot of the news that we're getting out of China is not bullish one bit. I don't care what anyone says. It's dangerous to be seeing banks consolidating smaller banks. Usually tells you that there's a huge debt problem. If they continue to inject liquidity, that just means that they're selling off US treasuries, and eventually that's going to catch up with us. And we're already kind of seeing it in the regional banks, right? There's liquidity concerns, there's collateral concerns. Once the Fed has no more vehicles for liquidity injecting to some of these banks, we're going to be seeing pretty much everyone just strapped for cash and trying to find cash everywhere they possibly can. And I think people underestimate how fast that could actually spiral out of control. And again, everything's interconnected. So I did want to, before we wrap up, talk a little bit about what happened in 2008 and what's happening now, because I think I told you yesterday, a lot of the guys from The Big Short were on CNBC, and they said that the Fed learned a lot from 2008, and they're kind of in a good position now that if anything happens, they know how to deal with it, right? I don't know if you believe that. I personally don't believe that one bit. Um, I think it's a
I
nice
believe
idea to
it
say.
to an extent. I think that if we see a similar situation, there will be enough different variables to where it's going to throw a lot of curveballs at the Fed, but they should be somewhat better prepared, I would hope.
I am not so sure. I think that they've got a good grasp of how to deal with crises for the most part. Steve Eisman from The Big Short was saying that Silicon Valley only lasted a day. It's like, yeah, because you guys threw fucking money at the problem, right? You pretty much bailed out a lot of those banks. You helped them out. However, by doing that, the capital requirements for a lot of these banks also went up to the point where they are scrutinized just like the other bigger banks. And it's like, well, they don't have the liquidity for that. So that's an issue, especially in a liquidity shortage. It's a very bad thing to be looking at. But there's a lot of things that happened in 2008 that didn't necessarily get resolved. And I think a lot of where we are right now is from 2019, which is also very much directly influenced by 2011, what happened in Europe, and obviously 2008. But 2008 was an American problem with housing, right? That's what we're told, that the housing market was the reason that we saw the great financial crisis, then it affected the banks and everything blew up. Well, if it was an American problem, why did it end up in Iceland? Why did it become a huge problem over in Greece, right? That's something that we never really go over. And when we see things with China, they're like, well, if that's just a problem in China, it's like, well, can it do the same thing that happened in 2008? Can it reach, Iceland? Can it reach Greece? Can it reach other parts of the world that their economies absolutely just shut down to the point where they just slow to a halt? Yeah, because the problem isn't necessarily what they're saying the problem is. The problem is that the monetary system is broken. It's not only broken, it's just to the point where people that are in charge do not understand how this stuff works. I talked about the labor data statistics. If they're operating on that, rates remain higher. The banks are crying for help right now. I know the banks in funding program came down by 2 billion or so, and the reverse repo went up a little bit, but that's one day. We can continue to see how that plays out going into March 11th. But those problems are going to continue to be problems because the rates remain too high. These banks cannot withstand this. And I don't know if this is Jerome Powell's second time being here, right? He was cutting rates in 2019 when the banks were seeing a lot of problems. And then by February 2020, that's when we started to see a lot of the COVID stuff came out and the banks collapsed. It's kind of a crapshoot to guess what actually would have happened without COVID, but most likely it would have been a very similar situation. And again, it was going into an election year too. So that's a really interesting thing there. Now, this is his second time around. You would think he would have learned from what happened when he cut rates. Maybe that's why he doesn't want to cut rates also, right? But these problems are interconnected because when you constrict capital and these banks do not lend, they cannot create that new debt. That means that there is not enough money circulating in the system to keep the economy running because we are a debt-based economy. If no debt is being created, slows to a halt. We start losing jobs. We lost a lot of jobs in January. We're just not admitting it, right? Eventually, at some point, the Fed is going to get this wrong, and they've gotten it wrong every single time. We've had a hard landing every time we heard that we're going to get a soft landing. But the thing that I think is most dangerous about 2008 that we didn't learn and Congress didn't even act on is the fact that the derivatives market was never regulated. And that's kind of the reason why we have massive exposure in other countries that everything just blows up. I saw an article yesterday that the total derivatives market in the global economy is $187 trillion. Trillion. That's 2 times the world GDP or something like that. That was the statistic. Now, how accurate is that? I don't necessarily know, but I do know that the derivatives industry and derivatives market is extremely dangerous, and easy money isn't always as easy, especially when things change. And we're at a critical point right now where there's not enough liquidity, there's not enough collateral. And if the Fed keeps rates this high and one bank says we're fucked, yeah, there we go. House is 100% right. Everyone's extremely levered. Everyone thinks that we're in a bull market. They don't think that anything bad could ever happen. The derivatives were the reason why we saw problems in Finland. I mean, not Finland. We did see problems in Finland, but Iceland. We saw problems in Greece, and we're seeing problems with the banks back in 2008, and we didn't learn. And we actually lobbied against derivatives being regulated in the period from 2009 all the way to 2011. So now we got derivatives once again. Everyone's levered the fuck up. Stock market's at all-time highs. Debt is pretty much being diminished. There is no debt being issued, and the Fed is keeping rates this high. We are talking about the perfect scenario where they fucked up and there's nothing they can do about it. It's only a matter of time. So it's one thing I do want to talk about because no one is talking about the derivatives market. No one's talking about how this is going to absolutely blow up in the Fed's face. Everyone thinks that the soft landing is coming. There's no such thing as a soft landing. That's just something they tell you so you go to bed happy with your positions wide open and, levered the fuck up, as House says. But this doesn't end up well one bit, and we know it doesn't because it never has ended up well. But derivatives is something that's really interesting, and that's why I always bring up the VIX too, because that's a big derivatives market. People think that it's easy shorting that thing. Okay, wait till it's not. Wait till you get a pop above 18. Wait till you're 20. Then everyone's trying to cover. The next thing you know, you're at 32. And everyone's trying to cover still. Then you're at 45. That's how it's going to play out. But 4 stocks are holding up the market. I hope everyone feels great about that. Those are probably the ones that are the most maxed out too.
Oh, buddy. All right. Add that quote to the
I
book.
agree.
Yep, there we go. Okay. That's how we're going to wrap it up for today. Appreciate that rundown, Kevin. And yeah, all of the derivatives, the leverage, just
They'll kill us all.
People get greedy, man. They get greedy. They don't learn from previous mistakes that others made because they just want as much money as possible. But at some point, you got to be happy, and money doesn't buy happiness.
No,
Bullish
money never
on
sleeps.
Yep, get that uranium house.
It might not be a bad player house. I was looking into it. I haven't done too much research, but we should talk about there. Maybe have you on the show and talk about uranium maybe next week.
Yep, let's do that. All right. Have a great weekend, everybody. If you haven't yet, hit that like button, subscribe to our channel, drop a comment. We're going to have a little bit different week next week. I am going snowboarding, so I will be out for most of it, but I know Kev is going to have stuff figured out. We'll do the best we can to keep everyone updated on what's going on out there. But appreciate you all, as always. Have a great weekend. Stay safe in the markets, and we will see you next week.
Take care, everyone.